What's going on, everybody? You know who it is. It's Austin, aka More Than an Agent, and this is the Real Estate Blueprint Podcast, the podcast for the Black and Brown community, the real estate podcast for the Black and Brown community. Here with my Dominicano hermano, Jonathan Soto. So what's going on?
What's going on, my guy? What's going on? All is well on my end. You know how it is. Daily grind, like you say.
Your daily grind, one day after another, each and every day that we get up, it is what it is. Welcome to it. Not knocking it at all. Today's show is about the four loan types, or the four types of loans, or the four loan products that you can use in order to purchase your first home. First home, and most likely next home as well. And that's single family buyers. That's if you're looking to purchase a multifamily. Same thing, four loan types. Before that, please do take the time to subscribe, like, share the podcast any way that you can, especially on our platforms. This is exactly how we're able to share the sugar, able to share these gems, these giveaways, these takeaways. Please, if you can, leave us a rating and review as we continue to grow this show, because it definitely helps us. And we're just trying to help y'all pour back in the eye. And that's what the main motive of this particular podcast is. So please don't forget that. Definitely click the link in our bio, where we have a bunch of resources and opportunities there for you, just in case you are looking to make a move, just in case you are looking to accomplish whatever goal that you do have in the real estate space, especially for 2023. So please take the time to do all of that as we get into this podcast here. Seems like you was about to say something, Soto. You good?
No, I'm good. I'm ready to rock and roll, ready to talk about these loan products.
Please take the time. And we guarantee to make sure that we continue to add value to your lives while you are taking the time to listen to us. And let's start it off. Four types of loan products that you can use, for loan options for you to buy your first property or your next property. Let's run it through all of them. Soto, let's start off with the first one. What do you have as far as the first loan product that somebody can use in order to purchase their first home?
First house. My favorite, FHA loan. You don't have to have perfect credit. You can have some things in your credit. You can have maybe some collections, some stuff going on in your credit. It doesn't have to be perfect. They're not gonna hit you so much on the rate for that. You can buy up to a 4-family house, 1 to 4 units with 3.5% down. That's how we started our journey. That's how we started building our generational wealth. That's how we started buying our portfolio. So I think my end is the perfect loan depending on your situation. You don't have to go FHA. Depending on what you have your credit going on, how many units you're buying, what's your max budget. If you want to maximize that budget, they're more flexible. They let you qualify for more. So my end, let's start off with FHA.
It's been a go-to catalyst of the reasons why we've been even able to build our portfolio. I mean, it's one of the most underrated loans that are out there. And I say this all the time, but if somebody if Cash Money Records, if Apple, if Tesla all went on sale for 3.5% down, you know what I mean? You think the real estate market is bad with multiple offers. Imagine if those companies would have gone on sale for 3.5%, you know, where you were able to fund the purchase and acquisition of that business for 3.5% down. So it's totally game changing. Number two, which I'm glad that you started off with FHA, because usually people conventional or the typical loan product that people kind of throw around around often. So I'm glad that you started off with FHA as number one. So it'll be interesting to see, is conventional number two, or you got something else up your sleeve? What's the number two?
Number two, I have USDA loan.
Interesting. Okay.
So this is not a one size fits all. You have to meet the requirements. The credit score is similar to your conventional, a little tougher, but it's still flexible. The debt to income ratio, whatever, if you qualify for a certain amount for FHA, you're going to qualify lower for USDA loan. It has its mortgage insurance, it has the monthly and the upfront, but you can buy a single family house with 0% down. The address has to meet the USDA guidelines. Surprisingly, a lot of our areas in the United States do meet that. If you're closer to the city, more populated area, it's not going to meet that. But if you're more, let's say, west, north, south, east, whatever it is to that specific area, you can definitely meet that criteria. Most of New Jersey, I believe, meets it. It's just this section, Essex County, close to the city, doesn't really meet that criteria. Don't quote me on most of Jersey, but a lot of parts of Jersey can meet the criteria. 0% down.
I always thought it was wrong. I say rural. I mean, clearly it is rural, but I always thought rural was like just like by the farm, right? Like in like the like haystack, like is like the tumbleweed is like going across like the road, right? There's nothing out.
You gotta have a chicken. You gotta have a chicken to qualify.
If there's a multifamily on the farm, best believe. I swear to God, I'm making an offer. Like, give me all 3 units. Give me the chicken coop. Like, give me all of it. Like, with no doubt. All right. Okay. So number 2 is USDA, 0% down. Number 1 was FHA, 3.5% down. What's number 3 as an option for somebody that's looking to purchase their first property?
Conventional.
Okay.
So with convention,
old faithful, tried and true, like just conventional.
Yeah, conventional. For me, I feel like it's the end product, because with conventional, you have no mortgage insurance, because you can start out with an FHA.
Interesting. Okay.
Once you have that equity, refinance a conventional loan, remove the mortgage insurance. That's your forever loan. Cash out refinance within that loan. It can sometimes it may not be your end loan product, depending on your situation. If you're buying multifamilies or FHA, it doesn't make sense. Rates are going higher and you don't refinance, you just leave it at FHA because you have a good rate and it doesn't make sense. But most of the times, that's usually your end goal once you have that equity and refinance into conventional. And if you want to pull out some equity, they do have 3% down payments for conventional loans. You just gotta, there's certain restrictions with that. You have to meet the median income in that specific area you're buying, and you have to take the first time home buyer course. But for the most part, it's usually 5% down. Not all banks offer this, but there are options for 1, 2, 3, and 4 families with 5% down. Most banks have 15%, 20, 25%, even if you're living in the property. So get the right team, understand the products, understand what you're getting into, and you could possibly get a 4 family with 5% down. But be careful when it comes to conventional. The lower credit score you have, that can impact your rate as well as your monthly mortgage insurance. With FHA, is a flat percentage for mortgage insurance. When it comes to conventional, it can fluctuate depending on your DTI, debt to income ratio, as well as your credit score.
I like the fact that you pointed out the conventional is almost like an end goal product, right? Like, especially like, depending on what you're looking to do as far as like your home buying journey. But I like the fact that that you labeled it as an end journey and a goal that is almost subsequent to how you originally pulled the trigger and how you originally closed on the deal. And usually it's not explained like that, because usually it's like conventional is like, this one's the best one, like this is the best option, this is the best opportunity, this is the best financing, and so on and so forth. And I like that, like you're changing the narrative on it just on the strength of like, no, don't get me wrong, right? Like from a conventional versus FHA, like the one that qualified for conventional, like it was a lot harder, right? And that person is, maybe more quote unquote, like more qualified. But here's how conventional can hold you up based off of what your goals are. And it's love it. All right, cool. Conventional, number 3 on the list. Interesting. Usually conventional is number 1 and number 2, and you have it at number 3 on the list. All right, cool. All right, you're just shaking shit up here. All right.
You gotta shake it up.
Number 4.
Come on. You gotta shake it up.
It's typical. And we're trying to pride ourselves on not being a typical podcast. And we're not gonna give you the typical information that you can find on a pamphlet, on a brochure, or anything like that. So if that's number 3, then what do you have as number 4?
So number 4, I was thinking specifically for our veterans, VA loans. You have to be an eligible veteran in order to qualify. 0% down. You can have the credit score doesn't have to be perfect. No mortgage insurance. You can typically probably buy a house with 0% down, depending on the area, depending on the price point, depending on your closing costs. You can buy up to 4-unit. So that's huge, 0% down, VA loan. And if you have entitlement left over after you live in that house, you can go buy another house with a VA loan, another 0% down, if you have that entitlement left over after your first purchase. So VA loans, you must be veteran. You got to be eligible. That's the only way you can be able to get a VA loan.
So they don't operate on the same thing as like FHA, like as far as like the 100-mile away, like kind of that really. So wait, okay, all right, let's back up. So somebody buys, and Newark, New Jersey, right? Somebody buys in Newark. Somebody can use that same not FHA. Somebody can use that same VA loan again in a different city as long as they do what?
They have eligibility left. So basically you're allotted a certain amount. And let's say you use half of it. You can use your other half in the other home.
So you're approved up to $1 million in eligibility. That means you can buy a $500,000 4-family and then another $500,000 4-family.
If you qualify, remember, your income has to still qualify.
Right.
Technically, yeah.
Right, but in theory, like you would be able to go after that, especially if your current rentals are doing what it's supposed to do and adding to your income.
Yeah, but VA is a little different. If you don't have landlord experience, you can't use rental income.
If you don't have land or experience.
Landlord experience.
Oh, landlord experience. You don't have landlord experience. And what's considered landlord experience? Like if you're there for a year and you have the
next one you can use rental income. Yeah.
Experience of being a landlord for a year.
I think it's 6 months or more. I'm not sure exactly how much, but there's a time frame.
All right, so all that to say that like you wouldn't be able to close in January, in July, and then be looking back in August and trying to buy the next property.
Mm-hmm.
But for the new year, like you still would have an opportunity to.
Yeah. And regulation always changes. We don't know if that can hold up for so long. You never know. Maybe they'll change their guidelines. FHA guidelines are always changing. Conventional guidelines are always changing.
Good point. Right. That's a good point. Those four alone, like I think a lot of people think that they have to like jump through hoops for a particular lending program or a lending package that offers them like everything that they're looking for. And I think that these 4 like core like lending practices in general, or just lending programs and packages in general, I think it's personally like what anybody like would need for the rest of like their particular journey, unless like you're really trying to like scale and like buy as many homes as possible, that like the other creative financing techniques come into play.
And that's what we got to talk about. I want to give a little bonus to my self-employed and creative financing.
Well, let's do the bonus. Let's run through the bonus, because that could be a whole, you know what I mean? Like there's a plethora of loan packages out there that are for
That could be a whole nother podcast,
the
actually.
investor, for the 1099, the self-employed, the entrepreneur. That is the next one. The give one though. Give one as a bonus. If someone's coming to you with a 1099 and maybe they just quit their job last year, but they're making a killing as an entrepreneur on the 1099, what loan product could they go after?
So your typical government loans will want to make sure you have 2-year tax returns, and they'll look at the profit, what after all the expenses. We have an investor that does 1 year 1099 and looks at the gross.
Interesting. 1 year's tax returns and just the gross.
I didn't say tax returns. I said 1099 gross.
Oh, wow. All right, so not even all right, so not even what's claimed on taxes. All right, so whatever your 1099 is, plus your gross, like what, like year to date, like if you just provide a profit.
1099, whatever it reports on your 1099, the 1 year.
All right, so whatever it
they'll use that.
is on your 1099, they're gonna go based off of that. The lending gods have descended on earth.
You're gonna pay, of course, it's gonna be a higher down payment and rate will be different.
That's fine.
But
I mean,
it's something doable. That doesn't have to be your forever loan. You can get in the door with that loan once you have that 2 years, once you have the tax returns, refinance out of it.
Then refi.
There's so many interesting programs out there that it's for like different investors. It's pretty interesting.
That's interesting. As a bonus, like that one's amazing. I'll rock with that one. And for everybody that's listening, those 4 and now 5, obviously, just options. Don't delay. Be hasty. And when I say be hasty, it doesn't mean about being hasty on pulling the trigger on an opportunity on a house or submitting an offer on a house, not knowing everything. I'm just saying be hasty in your diligence, AKA if you're just getting started, like the very first thing is to go grab your peer approval and know what loan product you're actually going to go after, knowing how much you have to put down and starting off with that, but doing that in a hasty manner. So even if you're not ready this very second, at least you have what you need in order to be ready 3 months from now, 6 months from now, a year from now, and at least you're not wandering aimlessly on thinking that you know what you need to do and not having the actual data that brings you closer to the goal. And with these 4 loan products, well, 5, sorry, again.
Nah, 4 with a bonus.
Again. With those particular 5 loan products, make it easy. 4 in a bonus. With these 4 loan products and the bonus product, you clearly have more than enough of what you need in order to make that first step into seeing what you qualify for and knowing how much you would have to put down in order to participate in that particular loan product. So don't delay. Click that link in the bio. Be sure to leave the rating and review. Those are 4 mortgages plus the bonus of what you can use in order to purchase your first or your next property here on the Real Estate Blueprint Podcast, which is the real estate podcast for the Black and Brown community, trying to make it as easy as possible. This is Austin Smith, aka More Than an Agent, and Jonathan, aka John Does Real Estate, signing off.